Good evening, guys. And now we are going to do the last module, which is module 9, with the topic year-end procedures. Year-end procedures. Okay. Okay. The second slide. The second slide tries to explain what the profit is. Generally, how do we get profit? We get it by taking income and minus expenses, and then we get the profit. As you can see there, our profit is made by income minus expenses. Now the profit is divided into two. We have what is called gross profit and net profit. What is gross profit? How do we get it? We get it by taking our sales and minus cost of sales, and then we get gross profit. And if you can remember the income statement, that's how you get the gross profit. You take your sales and you minus your cost of sales. Now, what is the net profit? The net profit, you calculate it by taking your gross profit. Sorry, there's an error there. We have an F missing. Take our gross profit that we calculated there. We minus our operating expenses. That's how we calculate net profit. Now, there are two accounts whereby you find your gross profit and your net profit. We have what we call trading account. Trading account, we use it for calculating gross profit. When we say sales minus cost of sales, we get gross profit in a ledger, in a T account. That account, we call it a trading account. Then again, we have a T account or a ledger account called profit or loss account. We use it for calculating net profit. If you can remember net profit, we said we're taking our gross profit that we have calculated from the trading account, and then we minus all the operating expenses. That T account or that ledger account is called profit or loss account. And then thirdly, we have what we call profit or loss statement. Now you need to distinguish or differentiate between an account and the statement. The account is a ledger account, which is a T account, and which has a debit side and a credit side. So meaning it is horizontal. The structure is horizontal. And then the statement is vertical. Alright, the statement is vertical. What do we use the profit and loss statement? We use it to calculate both the trading account and the profit or loss account. That means it's a combination of the two accounts. And then when they are combined, they form a profit or loss statement, which we sometimes call income statement. Okay, I hope that is clear. Okay, let's go to the next slide. Now let's focus on the trading account. Okay, what did we say we use the trading account for? We use it to calculate gross profit. How do we get gross profit? We take our sales and we minus our cost of sales, and then we get gross profit. Okay, Now in an exercise, sometimes the cost of sales is given to you. So say for example, they say the cost of sales is 50,000. They give it to you. Sometimes they don't give you the cost of sales. You have to calculate it. How to calculate it? You take your opening stock or opening inventory. You add the purchases. If there are any costs related to the purchases, like the carriage for purchases, that means the transportation of your purchases, you add it. And then you add also, if for instance you have bought the goods from other countries, you pay the custom duties, that is the cost. And then you also add the import duties. All right. If there are any returns from your purchases, maybe they are damaged goods that you have bought, then you are returning it to the supplier. You minus those returns. And lastly, you minus the closing stock or closing inventory. Sometimes they only give you opening inventory, they give you purchases, and then they give you closing inventory. It doesn't have to be, you don't have to have the carriages for purchases, custom duties. It depends on the question. It depends on the question, okay? That's how you calculate your cost of sales if it is not given to you. Now guys, you need to remember the structure. You need to memorize the structure so that you know it. Okay. Alright, let's go to the next slide. Now, how do you write your trading account on a ledger account? How do we do it? Okay, remember we said a trading account, we can get it, we use it to calculate gross profit. So how do we calculate gross profit? We say sales minus cost of sales is equal to gross profit. So in this example, the cost of sales is not given, so we have to calculate it. Remember the structure from the previous slide. Okay, we have the sales on the credit side, which is 420, minus the cost of sales, which is not given. We have to calculate it. This is the cost of sales, this amount. When you add it, it gives you the cost of sales, and this one and this one. Okay, you have the opening inventory plus your purchases. If you have carriages on purchases, you add them. If you have custom duties, you add them. If you have import duties, you add them. Alright, and then you deduct your returns if you have them. Then how do you deduct your returns? You deduct it by putting them or recording on the credit side. And lastly, if you remember the structure, you minus the closing inventory. Okay, so it will be your sales minus your cost of sales made by this amount and this amount and this amount. They will give you a gross profit of 192. Okay, I hope this is clear to everyone. This is clear to everyone. Okay, that's how you do your trading account in a ledger account. Okay, let's go to the next slide. Now we are done with the trading account. We coming to do the profit or loss account. What did we say is the purpose of doing the profit and loss account, we said is to calculate net profit. And how do we get net profit? We take our gross profit that we have calculated, we minus operating expenses. Okay, how is the format? You say gross profit. If you have any other income, you add the other income, and then the answer from that adding becomes gross income, not gross profit, gross income, because you have added other income, and then you minus your operating expenses, then you get your net profit. Okay, you must remember this structure. Okay, sometimes they don't give you other income. It doesn't mean you are wrong. We are just going to say gross profit less operating expenses. Sometimes you have other income. You say gross profit plus other income, and then that gives you gross income, and then you minus your operating expenses so that you can get your net profit. That's a structure. You have to know it. Alright, let's go to the next slide. So how do you write your profit or loss account in a ledger account, a T account, whereby you have a debit and a credit? Alright, remember we said net profit is gross profit minus operating expenses. If you can remember from the last previous slide, we calculated a gross profit and then we got 192. So you take that gross profit, you put it there on the credit side, and then you write trading account because it's coming from the trading account. Okay, and then if you have other income, you add other income. Maybe you have a rent income, or maybe you have commission income. You add it. Any income, any other income, you add it to your trading account or to your gross profit. If you remember the previous slide, this is your gross profit. Okay, the reason we write here trading account is to show that it is coming from the trading account. So if you remember the previous slide, we said you say gross profit plus other income, in this case, which is rent income and commission income, and then you minus your expenses. These are your expenses. These are your expenses. Okay, you have rent expenses, which is 16,000, salaries 25,000, insurance 1.5, postage 500, telephone 800. Now it doesn't have to be these expenses. It depends on the question paper, which expenses are they talking about. And then when you take this gross profit or trading account plus rent income and commission income, which is your other income, and you minus your expenses, you get your net profit. You get your net profit in red here. Okay, you see these two accounts, they go together, but in order for you to do it right, you must start first with the trading account, whereby you say sales minus cost of sales. It gives you gross profit, and that gross profit you are going to use it to calculate net profit. So when you open your profit or loss account, your gross profit or trading account will be on your credit side, and then you add any other income, and then you minus your expenses, which are on the debit side, and then the remainder or the balancing figure will be your net profit. Right, next slide. Now we are done with trading account and profit or loss account. We are done with that. We are done with the accounts. Now we are going to do the statement. The statement of profit or profit or loss statement. Right? It is also referred to as income statement. Okay. It combines the trading and profit or loss accounts. All right. So the layout is vertical, unlike the two accounts which are horizontal. This one is vertical. It starts from the top and it goes down. It does not come from the left and to the right. No. Okay. Let's see how the format is arranged. Next slide. Let's see the format of the statement of profit or loss. Now, this is a profit or loss statement, or statement of profit or loss, or you can call it income statement. This is how you do it. You put the name of the business, and then the title is statement of profit or loss for the year ended, whatever period they give you in the question. In this case, we say December 2021. Sorry. Now, the first part, okay, all this information is the information we wrote in our trading account and profit or loss accounts, if you can remember. So the first part of the statement is your trading account. This first part, from sales until gross profit, if you can remember. Remember we said the statement combines the two accounts, ne? So if you can still remember, our sales were 420, and then less cost of sales, which was not given to us. We had to calculate it. We have taken our opening inventory 30,000, purchases 210, carriage on purchases 3.5, and add customs duties 1.5. We add import duties 1.7, and then in this example we had returns on purchases. You minus them, and then you minus the closing inventory, and then all this amount will give you your cost of sales, which is minus 227,500. And then we do our calculation. Sales minus cost of sales is equal to gross profit. If you can still remember the trading account, 192,500. And then also in our example we did have other income, which were rent income 8,000 and commission income, which was 5,000. When you add them, they give you other income, which is 13,000. You add it to your gross profit, and then it gives you your gross income. Gives you your gross income, right? Sometimes you don't have this part, other income, so you'll come from this part, from here up until here. But if you have it, you have to do it. Okay. Now we have our gross income, which is 205,500. Okay. Now we come to the second part, which is your profit or loss account, if you can still remember, whereby we minus operating expenses, which were rent expense 16,000, salaries 25,000, insurance 1.5, postage 500, telephone 800. When you add these operating expenses, they give you the total of the operating expenses, which is 43,800, and then you minus it from your gross income. It gives you your net profit. Gives you your net profit. Alright, I hope this is clear. Also, don't forget two things. The structure of the profit or loss statement is vertical. like it comes from here and goes down. Okay, but the structure of the trading account and profit or loss account is horizontal. It's horizontal. That means you are working on the debit side, you are also working on the credit side. Working on the debit side, working on the credit side. It moves like this. But the statement moves like this. Okay? Okay guys, let's go to the next slide. Right. The next slide talks about the statement of financial position. It talks about the statement of financial position, which is sometimes called the balance sheet. Sometimes called the balance sheet. So the balance sheet reflects an accounting equation. You are going to see the structure. The only items that are there is your assets, owner's equity or equity, and liabilities. So when you are talking about the balance sheet or statement of financial position, you must know you are talking about your accounting equation, whereby your total assets must be equal to your owner's equity plus your liabilities. When you add your liabilities and owner's equity, that amount must be the same as the amount of the total assets, right? For instance, if assets are 400,000, then adding owner's equity and liabilities should balance or be equal to the value of our total assets. Okay, and if they don't balance, that means there's something wrong. Okay, now let's talk about these. Let's talk individually on these items. Let's start with the assets. Okay, we know the definition of an asset, mostly. Now your assets will be divided into two, which is current assets and non-current assets. It's non-current assets and current assets. Those are your assets, and then when you add them, you get the total value or the total amount of assets. So what is your total assets? Your total assets, you get it when you take your non-current assets, you add your current assets, and then you get your total assets. Okay, let's go to the next item, which is owner's equity or liabilities, whichever comes first. Okay, liabilities. Your liabilities, you know the definition of a liability is the debt of the business. Okay, it's when the business buys on credit or borrows money. Okay, it's money that we're supposed to pay to our suppliers, as which we call creditors or trade payables. Okay, so also your liabilities are divided into two. We have non-current liabilities and current liabilities. That's the second item. And then the third item is the owner's equity. Sometimes you just call it equity. What is it? It is the interest of the owner in the business. Alright. And then what is total equity? Your total equity is when you add your owner's equity plus your liabilities. So your total equity is owner's equity plus liabilities, gives you total equity. Now you must remember, I've said it with the accounting equation, that the value of the assets should balance or should be equal to the value of the total equity. What is the total equity? Is when you add owner's equity plus liabilities. Don't forget that. Alright, let's go to the next slide. Now, your statement of financial position or your balance sheet, we have what we call notes. Okay, notes. Your notes are your calculations. Okay. On the face of the balance sheet or statement of financial assets position, we don't do calculations. Okay, calculations we do them in what we call notes. All right, in what we call notes. Okay, you can check that on your textbook on page 218 to 219. Okay, we have notes for property, plant and equipment, which we call PPE. We also have inventory, the note for inventory. Note number 3, financial assets. Your financial assets will be something like your fixed deposit or investments. An investment is an asset, but a financial asset. Your fixed deposit is an asset, but your financial asset. Okay. Note number 4, you do a note on trade and other receivables, that is your debtors. In note number 5, you do your cash and cash equivalents. Note number 6, you do your non-current liabilities. In note number 7, you do your current liabilities. Okay, please look at that on those pages. Okay, next slide. Now this is a structure. This is a structure for the statement of financial position. Okay, the statement of financial position. This is a structure. How do we write it? Firstly, you write the name of the business. You write the title, which is Statement of Financial Position as at 31st December 2021 according to our example. Alright, and then you start with the assets. Okay, you will have the assets. Firstly, your structure must be structured like this. You must have your notes, the column for the note, and then you have, I advise you that you have maybe 2 or 3 columns for the rents or for money. Okay, that's an advice. Okay, remember we said the statement of financial position is just a reflection of the accounting equation, which is assets is equal to owner's equity plus liabilities. Okay, so the total of the assets must be the total of the total equity, must be the total of this. Okay, now if you look there, we said assets are divided into 2, non-current assets and current assets. Your non-current assets will be your PPE, which is property, plant and equipment, and other financial assets, which is maybe your fixed deposit or your investment. Now with the PPE, we have note number 1. What does this mean? This note means this amount. How did we get this amount? You must go and look for the calculation of this amount in note 1. That's what it means. This amount, you can see the calculation in note 1. Other financial assets, this amount, you can see the calculation in note number 3. Okay, it's like your workings. Your note is like your workings. And then when you add these non-current assets, they give you the total of non-current assets. Alright, then we go to the current assets. Your current assets will be your inventory. This amount, you get it in note number 2. So this amount you put here for inventory is always the closing amount of inventory at the end of the period. Okay, there's no calculation for it, you just put it there. You'll see from the pages I've given you. And then we go to trade and other receivables. Your trade and other receivables, like your debtors. Okay, so this amount, this total amount, if you want to see how we got it, you go to note number 3. The calculation is there. Also with cash and cash equivalents, right? This amount, how did we get it? You go to note number 3, you see the calculation, how we got it. Okay, see the amount, how we got it. Right, now I want to explain something quickly. With trade and other receivables, for instance, you will have debtors which are 50,000 rand. That is people who have to pay the business 50,000 rand. And then maybe we have people or debtors that are irrecoverable. That means we can't find them for them to pay us. And then we write off their debt. Maybe it's 20,000. We write it off, and we call that what? Bad debt. So it means we are not going to get the whole 50,000 because there are those debtors that we could not find, and then we scratched off, or we closed off their accounts, and then maybe they owe us 20,000. So that means out of that 50,000 we're going to get what? 30,000. So we don't write this in the face of the statement of financial position. We write it on the note, whereby you're going to write debtors minus bad debt equals to 30,000, and then you go and come and put that 30,000 here. So if anyone wants to see how we got this 30,000, must go to note number 3 where we did the calculation. Also with the cash and cash equivalents, your cash and cash equivalents will be your bank, that is money in the bank. You will be your cash float, will be your petty cash. Okay, so we don't put all those monies here in the face of this book. Okay, we only put the total. But if anyone wants to see how do we got this amount, he has to go to note number 3. We'll see the calculation there. So these are current assets. The total, we put the current assets, and then we add non-current assets with current assets. As we have said, when we add them both, they give us total assets. Total assets 400,000. So your total assets, in order for your book to balance, must be equal to your total equity. We are going to see now. We are done with the assets. We come to the other part of the accounting equation, which is equity plus liabilities. Let's start with equity. Our equity will be our capital. All right, will be our capital. So this is our total, the total of a capital, and then this is the note. This is, if you want to know how we got this amount, you go to note number 4. Normally we will have our opening balance of the capital when we do the calculation, and then from the income statement or statement of profit or loss, we do have that net profit. We add it to the capital, and then we minus the what? The drawings, and then we get the total, which we put it here. So this is our total equity. Okay, done with the equity, we go to liabilities. Liabilities, we say liabilities are divided into non-current liabilities and current liabilities. What are non-current liabilities? Are things like long-term loans and borrowings, okay, your mortgage bond and other stuff. All right, we put our amount there, then we show it on the note. All right, so this is our total for non-current liabilities, and then we go to current liabilities, which is trade and other payables. Okay, we write our total here, and then we did our calculation here. Okay, we did our calculation here, right? And then also under current liabilities we have bank overdraft. We add it there. When we add these current liabilities, they give the total for current liabilities, and then when we add non-current and current liabilities, they give us the total for liabilities. So when we add equity and liabilities, they give us the total equity, which should be equal to the total assets. Okay guys, I hope that was understandable. Okay, let's go to the next slide. Remember, we have done so far how many books we have done the trading account, we have done the profit or loss account, we have done the profit or loss statement or statement of profit or loss, which we call income statement. We have done the statement of financial position, which we sometimes call balance sheet. Now we are doing the last one, statement of changes in equity. Statement of changes in equity. Remember, we said equity is our capital. If we have net profit, we add it. If we have net loss, we minus it. And then we minus drawings if we have drawings. All right. So what's the purpose of the statement of changes? Its purpose is to show how the owner can increase or decrease his capital. So it centers around capital, the movement of capital. Okay, why does the capital increase? Why does the capital decrease? What causes the capital increase? What causes the capital decrease? Okay, it also shows the final capital amount at the end of the financial year or period. Now this is the example of the statement of changes in equity. Okay, on page 219. Okay, statement of changes in equity. This is the title for the year ended 31st December 2021 according to our example. Okay, how do we do it? You take the balance at the beginning of the year, the balance of capital, you put it there, and then if we had net profit from the income statement, you add that net profit. Okay, but if we had a loss, and then we minus that loss, which is a minus in brackets. Okay, and then we minus the drawings if we have drawings, and then lastly we have the closing balance at the end of the year of our equity. We have the closing balance at the end of the year. That is the statement of changes in equity. Okay, please guys, watch these slides over and over until you understand, and then you must try to do the exercises in your textbook, and then we can organize the a day before you write, maybe 2 days before you write, and then we do this again. Okay, next slide. The end, and good luck. That was the end of the module, and thank you very much.